So upward trends are great. It helps us to buy low and sell high as we go up on the slope and we go up on the trend as the prices increase. But it's also very important to understand downward trends. And so we're talking about downtrends and how to be wary and how to trade downtrends and be, working through those types of trend lines. So in a downtrend, what you're really drawing is not support lines, you're drawing resistance lines. And again, this will be much more sense as far as when we actually draw the lines, you see the examples. But basically, you're starting at the highest high, you're looking at your candlestick at the wick of the highest high, and you're connecting to the next high that precedes a new low. And you can see the line here, it's going to have a downward slope. And as long as new lows are being made, you keep redrawing the line to connect the highest high before the last low. So you're drawing your line along the highs, but it keeps going downward, right? That's the whole idea of a downward trend. And when prices stop making new lows, then you stop drawing, right? And then you extend that line at the same slope out in the future. You want to see, you're basically extending that line all the way out. And you're watching that trend line. So let's look at that graphically so it makes a little bit more sense here. If you see this downtrend here, you can see where I started. The highest high, in effect, is where I'm starting at. I'm at the top of the candlestick now in the upper shadow at the top of wherever that wick was. If the wick on where my starting point was in the far left was even higher, I'd be starting up even higher. I would always start at the top of the wick in this case. And then I would be connecting it down through these next ones that, connect along the slope as far as you can see where it's, this downtrend has really been established. Where it says downtrend established, that arrow, that's showing at the third, a real close approach or touch of that downward trending line. You can see I had a first one there, I had a second one there. In fact, when the second one happens, they're right in a row there, that could have been an established downtrend right there. A lot of people would consider that that's fine, but if I really wanted to make sure, I could make sure it touches for a third time along those lines. But you can see we have a downtrend that is established, and you can see our downtrending line along those lines, right? So now we're watching this. We're waiting. We're either, if you're short selling or betting on prices going down as far as a strategy, you can continue to sell this, basically be trading along it, expecting lows to keep going lower, and they do. And let's say they keep going lower, and we now have a fourth test of the resistance line, right? So we can see that our resistance line there's been another test of it. Though this case, the prices went up and they stayed up. You can see how we've got white candlesticks where it kind of started to go up for 2 days, let's say, in a row. So that's a little bit interesting versus the third downtrend. It had a spike up in prices. People were trying to get it above that trend line in effect, but it went back down and went way back down. And you can see where it had that third touch, had a real red bar with a long upper wick. In this case, the buyers are trying to drive that price up on the fourth touch of the resistance. So that might be telling us something, and why candlesticks are helpful, that buyers are trying to do something here. Will they break through that line or not? That's what we want to watch for. Are they going to break through that line and break the trend, the downward trend, or will go back down again and keep going on that downward trend? By the way, if you look at that last price bar we have there, it may look like a dragonfly doji. It's not. It's got a little bit more of a body to it than a lot of dojis have, but it's kind of doji-like. But it's not technically it's not a dragonfly doji because there's no prior established uptrend. For a doji, you need to have an established trend, and we don't have an established uptrend. In fact, we're still in a downtrend, so it wouldn't really consider it as a doji and trade off it as a doji. But if you're looking at it and thought, hey, maybe that's a doji, good for you. All right, so let's see what happened in this particular case. Again, a real security. So it approaches that resistance line, but doesn't break through. But then you can see on the day after, it definitely breaks through that resistance line. I mean, it actually almost has a full gap up, but the whole candlestick body and the price ranges on the upper and the lower, all of them have gone completely past that breakthrough or broken through that resistance line. So that's a real telling that it really has broken that trend. Even if the upper shadow just goes past that resistance line, for many people, technically they'd say, yeah, once it does that, that breaks the rule as far as the resistance or the sell rule, and so we'd be, or excuse me, or in this case, it breaks the trend rule, not necessarily sell rule, but it breaks the trend. So the trend has been broken. The downtrend is broken, and then it kind of goes sideways and it kind of goes on from there. But when we were looking at this trend forming, we established that there was a true downtrend. We watched it approach that fourth time, and then it could have kept going back down, or in this case, it strongly broke through that trend line. So we strongly know the downtrend has ended.